Hey, we made it to Module 8. Congratulations on sticking through this entire course. I hope that you found that this is valuable. I won't get on my pulpit, but let me just say, one of the most easily recognizable common denominators of business is finance. And having your arms around what people mean when they talk about net working capital or the beta of a stock, or we're going to learn that tonight, don't worry yet, or being able to talk about what's a source of cash and what's a use of cash, or just talk about the time value of money. It has value. And I hope that over these past, however many weeks, 8 weeks, that a lot of this has begun to resonate with you. If it has, then this will be one of those courses that you can actually use after the class is done. And that's my goal. What we're going to talk about tonight, primarily, is going to be the cost of capital. Risk a little bit, other items a little bit, but primarily the cost of capital. This is where the Darden tutorial comes in. And if you haven't seen it already, it's about 12 minutes long. I suggest that you take a look at the Darden tutorial on the weighted average cost of capital. It should supplement what I'm saying pretty well. Now, we'll get to the definitions. I found out that if I do the definitions first, the screen freezes, so don't want the screen to freeze. And of course, it has frozen. Hang on. Nothing's ever easy. Okay, well, it's working. I'll start while I'm on a roll. We want to determine the firm's cost of equity. We want to understand this word beta and what that really represents. And even though it's not written here, we want to understand the weighted average cost of capital. The earlier chapters that we had, they focused on capital budgeting, and they focused on the appropriate size and timing of the cash flows. This chapter that you've just read discusses the appropriate discount rate when cash flows are risky. Let me phrase that a different way. You've got different sources of cash for your company. One of them is debt, one of them is equity. As we've discussed in previous modules, equity is the highest cost source of any funds that your company might decide to invest. Debt is much cheaper than equity, and that's why the cost of debt is lower than the cost of equity. There's a philosophical reason for that. If you take a look who gets paid out first in distressed sales, it's the secured debt holders. After that, the bondholders. After that, the preferred shareholders. Guess who gets paid last? The equity holders. The equity holders get paid from the assets of a broken down company after literally all of the other interested parties have been paid off. If there's any money left, then the equity holders get paid off. So, if there's one group that's most likely to be holding an empty sack when a company gets liquidated, it's going to be the equity holders. That's why equity is the highest cost form of financing, because it's also the highest risk form of financing. And risk and return, as you know, move in tandem with each other. The lower the risk, the lower the return. The higher the risk, the higher the return. So don't kid yourself. Companies that finance themselves with equity only are financing their company with the highest cost form of capital. That's why this chapter focuses on the weighted average cost of capital. Now, in order to talk about the weighted average cost of capital, it makes sense to understand what the cost of equity is. You've got a firm that has excess cash, and it pays a cash dividend to its shareholders. And it invests in a project, and the shareholders and the stockholders in general can reinvest the dividend in risky assets. So you want whatever the return on what they're investing in, you want that return to be at least equal to, if not higher, than the cost of their equity. So we've kind of got these benchmarks, but at the end of the day, what threshold do we use to determine whether we want to invest in a project or not invest in a project? Well, it should at least equal our cost of funds. Because if we're paying a certain amount of money to have debt and equity available to us, then the project we're investing in should at least be break even on what the cost of those funds are. If it's not, we're wasting money. So, in order to know the cost of our funds, we know the cost of our debt. That's the weighted average of all the interest rates we're paying on the different forms of debt. That's easy to calculate. If we have preferred stock, that's easy to calculate too. It's whatever the coupon rate is on the preferred stock. That's our cost of preferred stock. But what about equity? How do we determine what the cost of our equity is? Well, we've got a formula. I haven't taught too many formulas in this class, but I will point this one out. The cost of equity, which is shown right here, is the risk-free rate of debt plus the beta of the particular company we're looking at times the difference of two numbers, the market cost of that debt minus the risk-free cost of that debt. Now that's a mouthful, but we've got things that we can substitute for each of these. The risk-free cost of debt, simplistically, is the cost of a governmental bond or bill. The shorter, the lower the risk. But all the governmental issued securities, by definition, are risk-free. So you can take like a 3-month treasury bill, and the current interest rate on that 3-month treasury bill would be considered the risk-free rate. Beta is a way of calculating how a publicly traded stock moves in tandem with the market. Now, let's take a look at this in its simplest form. I'll come back to the definitions. Over time, the stock market kind of moves in waves. It's going to go up for a period, then it's going to go down for a period. It may not be as smooth as I've just drawn, but it's going to be similar. If a stock moves really high when the market goes up, and then really low when the market goes down, it's moving in tandem with the market, but it's magnifying the movement of the market. That stock has a beta that's greater than 1. It could be a positive 1.5, could be a positive 2, but it is a larger than 1 beta. Because it's positive, it's moving in the direction of the market. Because it's more than 1, it's moving higher than the market's highs and lower than the market's lows. Okay? If I were to talk about this as a theoretician, I would say that it has high systematic risk. Systematic risk is another name for beta. Beta is easier to say. If a stock moves in the opposite direction of the market, it's considered having a negative beta. If this stock went like this in good times and went like this in bad times, it would be considered having a negative beta. Not many stocks move in the opposite direction of the general market. A maker of Spam would be an example. People don't buy a meat substitute unless they really are low on money. So in a really bad economy, sales of Spam would be expected to go up. In a good economy, there shouldn't be as much demand for Spam, so it's going to be down. That's a negative beta. It goes in the opposite direction of the market. There's one stock that as of about 2 years ago had a beta of 1.00. It moved in tandem with the market. It moved up when the market moved up, and it moved down when the market went down. That company was Google. Now, I haven't checked Google's beta lately, but it was extremely close to 1.00. So there are stocks that kind of mirror the market. I'll take that one step further. If you put all the stocks in the S&P 500 together, what would the beta be on average? 1.00. It would be the market. It would move just like our black line right here. Okay. The last part of the cost of equity formula is the market cost of debt minus the risk-free rate. The market cost of debt is what that publicly traded security costs in the market today. In other words, if they were to issue debt, what would it cost? The risk-free rate, as defined, is going to be like a treasury bill, and we'll subtract that from the risk-free rate. We'll multiply it times the company's beta, and then we'll add back the risk-free rate, and that gives you that company's cost of equity. The example that we give here is a company called Stansfield Enterprises. It's a publisher of PowerPoint presentations. It has a beta of 2.5, so it magnifies the movements in the market. If the risk-free rate were 5%, again, this was done a few years ago and Treasury bills were paying a little bit more. If you assume the risk-free rate is 5% and the market risk premium is 10%, that means if the company were issuing debt, it would have cost 10%. The overall cost of equity for this firm would be 5%, which is the risk-free rate, plus 2.5 times, which is the beta, times the market rate of debt minus the risk-free rate of debt. Now, I'm embarrassed to say, we needed to explain there's a difference between the market rate of debt and the market risk premium. When they say market risk premium, they've already subtracted the risk-free rate from the cost of debt. So the difference is 10%. So that means the market cost of debt for this company was a whopping 15%. The risk-free rate was 5%. So the market risk premium is the difference between the two. It's 10%. So it's, when you come up with the cost of equity, it would be 5% risk-free rate plus 2.5 beta times 10%. When you net all of that together, the overall cost of equity for this particular company is 30%. Now, if you did your own company, there's a 99% chance your company's cost of equity would be south of 30%. But this is an extreme of what a really high cost of equity could be. If you were investing in projects and you had a company with a 30% cost of equity and you were largely financing your company with equity, you would only want to look at projects that gave you a 30% return. estimation of beta. It's a portfolio of all assets in the economy. It's probably something like the New York Stock Exchange, the NASDAQ. Those are examples of just baskets of stocks that help you compute what the overall beta is for that market. The sensitivity of a stock's return to the return on the overall market, that was the curved line that we were talking about before. And remember, another name for beta is systematic risk. Keep in mind that highly cyclical stocks have the higher betas. Also note that cyclicality is not the same as variability. Stocks with high standard deviations don't necessarily have high betas. One thing that I will say is if you buy a portfolio of stocks, like 7 or 8 different stocks, you can basically minimize the overall systematic risk, and you can bring down the betas of any individual stocks. So diversification is a good way to avoid systematic risk. Also, if a stock does relatively well in good times and in bad times, it's going to have a reduced beta, probably between 0 and 1. So it's not going to have the same fluctuations as the overall market. Now, let's take a look at definitions. Variable costs and fixed costs. We've talked about the income statement periodically, but the income statement is going to have some expenses on it that move directly with sales. Those are variable costs. They vary with the output of the company. You're also going to have some costs that are static. In the short run, they don't move even as output goes up or output goes down. Those are considered fixed costs. The mortgage payment on a building would be a fixed cost. If you change just one variable, that's called a sensitivity analysis. You're changing one variable to see how the overall equation changes. If you change 2 or more variables, you don't have a sensitivity analysis. You have a scenario analysis. Contribution margin is basically another name for the gross margin of the company. It's in very, very simplistic terms. It is the sales of the company minus the cost of goods sold of the company. Now, a purist is going to contradict me and say, no, 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 no. It is sales minus variable costs. That is your contribution margin. The trouble is, I have yet to see a financial statement that shows what the variable costs are. Cost accountants separate variable costs and fixed costs very neatly. But on an income statement, you don't have that luxury. So you've got to extrapolate. The easiest way to extrapolate the overall contribution margin is to use as a proxy the gross profit margin. More on that in a couple minutes. I'll show you a numerical example. Systematic risk we've talked about. Another name for that is beta. Financial leverage. Once you stop financing your company exclusively with equity and you start using something other than equity, like debt, to help finance it, you've introduced what we call here as financial leverage. Debt allows you to have financial leverage on your balance sheet. And that brings us to the weighted average cost of capital. Okay, I actually think I've got a slide here which might make this a little bit easier. Trouble is I have to click about 1,000 times to find it. I'm teaching this class face-to-face, I throw in preferred stock. Most of you are going to have two things to look at, not three. You're going to have debt and you're going to have equity. If you had preferred stock, there'd be a third set of numerators and denominators here instead of two. And I'll let you know what else you need to do after we go through this. The weighted average cost of capital basically gives weight to how much equity you've got in the company. It gives weight to how much how much debt you've got in the company, and it then gives you the overall weighted average of the two. That's where the name comes from. So you take a look at how much equity you have in the company, that's the numerator, and you divide by the debt plus equity in the company. You multiply that times the cost of equity, which we just computed, so we know how to compute the cost of equity now. You add to that the amount of debt in the company divided by the amount of equity plus debt in the numerator, and you multiply times the weighted average cost of debt. If you've got like 4 issuances of debt on your balance sheet, then you take the weighted average of all those individual amounts of debt, and the weighted average of the debt becomes your cost of debt. You then multiply by 1 minus the tax rate because you want to have the after-tax cost of debt. When you've done all this, you basically are able to figure out what the cost of capital is to your company, and any project that you invest in should at least be able to equate to that. You don't want to have any projects that return less than your weighted average cost of capital. Now, I've said a lot, but a couple of these things probably have made you scratch your head. Let me conclude this module by just going over a couple informational points for you. You can get the cost of debt from the balance sheet. For most companies, there's a few that are distressed and their debt might be discounted. But for most companies, the historical cost of debt can be used as a proxy for the company's cost of debt, and the debt on the balance sheet can be used as the overall weighted average cost of debt. So when we talk about debt in the numerator, we can actually get this number from the balance sheet. Debt in the denominator, likewise, these are the same numbers. They come straight from the balance sheet. The equity number does not come from the balance sheet. The equity number does not base itself on historical values. If I bought a piece of land in 1970 in Kenilworth, and say it cost $100,000, no one is going to believe that in the current year, that 1970 piece of land is still going to be worth $100,000. But you know what? On the income statement, on the balance sheet, it is going to be worth $100,000 because you go by the lower of cost or market. If the cost was $100,000, it doesn't matter what the market is. That land is going to be $100,000 as an asset on the balance sheet. But that in no way mirrors reality. So, equity in no way is going to mirror reality either. The equity may very well have grown over the years, but because we go by historical costs, it won't necessarily be reflected. So what do? We take the number of shares outstanding. You can find this at the bottom of the income statement. And we multiply that for a certain date, say December 31st, we multiply that, I'm losing my microphone, by the closing price of the stock for that certain date. So December 31st, closing price of stock. You multiply the shares outstanding by the closing price of stock, and you have the market value of equity for that company. It's based on market values, not book values. So the biggest hurdle for you to get your minds around on this formula is that the debt is a historical number, but the equity is a market number. Once you do that, it's real easy to figure out everything else. The cost of debt, go to the footnotes to the financials. You can see in the debt section what the cost of different issuances of long-term debt are. You take the weighted average of that, that's your cost of debt. The cost of equity, the formula that we went through, the risk-free rate plus beta times the market cost of debt minus the risk-free rate, that gives you the cost of equity. You've got all the components you need, and you take the weighted average, and that interest rate becomes your weighted average cost of capital. If you had preferred stock, you would simply add into that the book value of the preferred stock times the coupon rate, whatever that interest rate is, and that's also in the footnotes to the financials, the coupon rate of the preferred stock. So historical cost of preferred stock times the coupon rate would give you a third variable here if you had to have three different issuances of debt. Debt, regular debt, preferred stock as a form of debt, and then equity, which is a category all unto itself. Obviously, if there were preferred stock here, you would also want to add preferred stock to this numerator, the preferred stock, I don't mean numerator, denominator. You'd add it to the preferred stock denominator, you would add it to the debt denominator, you'd add it to the equity denominator. In other words, instead of adding two things together in the denominator, if your company issued preferred stock, you'd have three variables to put in. Other than that, it would be identical to what we just looked at. I'm not emphasizing preferred stock simply because most of you do not have preferred stock in your companies, so it's superfluous. I hope this is relatively clear. This is by far the most difficult module, at least in terms of formulas. But again, we've tried to break this into bite-sized pieces so that it makes sense. That concludes all of the modules. We are going to have some informational modules to get everyone started with the project, and also to help you with doing net present value calculations. But for all intents and purposes, this concludes the modules that are directly related to all of your reading material. I hope that you found this helpful. Take care.